What principally are investors or your clients looking for when they want to look at non-public markets, various types of alternative options?
So our clients, as ultra high net worth clients, have always had a very large allocation to alternatives. And the approach has been to be quite diversified. So alternatives is a big category that's going to span private equity, private credit, real assets, and also hedge funds. The largest allocation has been going to our buyout strategies, so traditional private equity. But really the objective for our clients is how can they achieve differentiated sources of return from public equity and public fixed income returns? How can they add uncorrelated sources of return? And most importantly, how can they drive alpha or outperformance versus the returns they're getting in public liquid markets?
Interesting that you say that they're looking for outperformance as opposed to just a smoother ride. I mean, some of the criticisms of some alternative strategies is that, well, they don't mark to market every day, and you don't have to absorb that sort of noisy volatility on the way to whatever return you're getting. You're saying that they think that there's sources of better or different types of returns.
100%. Look, I think there is a benefit of perhaps not seeing the volatility or not having to live through the volatility. And I think one of the other hidden benefits of alternatives is it forces investors to stay the course, right? These are illiquid strategies. You're signing up for a 10-year commitment, and it takes the sentiment out of it, right? You're going to have to deploy capital. It's not at your discretion, and it allows you to really stay invested. And I think that's one of the hidden benefits of alternative investments.
Has private equity recently kind of lived up to the billing in the sense of, you're seeing these reports. First of all, there's maybe less activity in terms of new buyouts than you might expect given some of the other market conditions. And then just this idea that if LPs want to withdraw their money and the sponsors have to, take on leverage to do that. In other words, it just feels as if there's a lot of moving parts that maybe are not necessarily as clean as, hey, we buy companies, we lever them, we fix them, we sell them.
Yeah, look, I think that manager selection and looking at what is the actual strategy under the hood is incredibly important. I think now more than ever, finding managers that are driving real value creation at their portfolio companies and looking through as what was from cheap financing, how much of it was multiple expansion, like what was actually organic growth that was driven at those portfolio companies. That's incredibly important to be looking at today. You also bring up an interesting topic, which is liquidity.
Yeah.
And so one of the interesting areas within private equity right now is secondary private equity, right? So you've had institutional LPs that have now gotten to targets in terms of how much they want in alternatives that are finding themselves, given the lack of distributions coming back, finding themselves needing to potentially sell. And as a liquidity provider, that's an interesting strategy to be a secondary private equity investor today.
Should anybody's antenna be raised by the idea that now you have these managers who want to open up to high net worth individual money as opposed, why am I so lucky to be getting this opportunity kind of a logic?
Well, I do think it's one of the most interesting moments. So in the last 25 years, I've been at the intersection of wealth and alternatives for individual investors because you've never really had access in the way that you do today. For the ultra high net worth investors, it's top tier managers that are thinking about how they're going to grow their business over the next 20 to 30 years and realizing that they need to tap into individual investors to grow their business, right? And so it's projected that if there's $4 trillion today of individual money in the private markets, that's going to triple in the next decade. And so alternative asset managers are figuring out how do I access that capital. But the other part of that is going downstream and thinking about how do you get to the mass affluent, how do you get to retail. And so what you're seeing is the advent of new structures that allow for that. So in credit, the non-traded BDC, in real estate, non-traded REITs, and then you're seeing private equity and other real asset strategies going into these open-ended evergreen structures, some of which allow you to go to smaller investors that don't have to meet the $5 million minimum net worth for traditional alternatives. But these structures also have a modicum of liquidity, because that's the other real challenge to investing in alternatives is you have to give up liquidity to be able to get that alpha in the private markets. And that's harder for smaller clients.
In a world where trailing equity returns in public markets have been pretty strong, and now you can get pretty safe yield above 5 and 6%. Does it raise the hurdle rate for investors wanting to go to less liquid strategies?
Well, I think, always looking under the hood, what's interesting. So with higher rates, you look at credit. Okay, so you can get pretty attractive yields today. But in the private markets, you can add to that and be getting low double-digit returns as a senior direct lender. So I think investors find that pretty compelling. And obviously, that's a product that's an investment product that has gone into some of these structures for broader individual investors. And I think the way our clients think about returns in privates is what is the spread that they can get above the public market return. And to give up that liquidity, generally looking for 300 basis points a year, better than the public market alternative.